All right, guys, fasten your seatbelts, because what we are stepping into right now is not just another economic cycle, it is a warning phase, a structural one. We are entering 2026 with the global system already stretched thin, and over the past few months, two of the most important monetary pillars in the world have quietly sent signals that should not be ignored. The United States and Japan are not announcing a crisis. They are doing something far more dangerous. They are choosing to manage instability by adding more liquidity to a system that is already overloaded. That is the core issue. This is not about panic headlines or imminent collapse. It is about accumulated pressure. When the two largest issuers of reserve and funding currencies both lean toward easier financial conditions at the same time, the consequences do not show up overnight. They build, they compound, and then they surface when the margin for error is already gone. Now let us be clear. This is not a moral argument, and it is not a political attack. It is a structural observation. The global economy today is running on an assumption that asset prices must remain elevated in order to preserve stability. That assumption is becoming increasingly fragile. Growth is slowing, debt levels are high, productivity gains are uneven, yet financial markets are priced as if liquidity will always be there to cushion every shock. That gap between reality and pricing is where risk lives. In 2025, a lot of policies were framed as temporary adjustments. Rate cuts were described as calibration. Fiscal expansion was described as targeted support. But as we move into 2026, those temporary measures are starting to look permanent. And permanence changes behavior. Investors take more risk. Governments delay reform. Households rely on asset appreciation rather than income growth. That is how systems drift away from resilience. So, the question we need to ask is not whether something breaks tomorrow. The real question is, what happens when the tools designed to stabilize the system start amplifying its weaknesses instead? That is the lens for this entire discussion. This is not about predicting a crash. It is about understanding why the room for policy mistakes is now dangerously small, and why the warnings from Washington and Tokyo matter far beyond their borders. Now let us zoom out and define the mechanism that sits at the center of this entire story, because without it, everything else sounds like noise. The global economy is currently trapped between three forces that all pull in different directions at the same time. The first is record levels of debt across governments, corporations, and households. The second is elevated asset valuations that depend heavily on low interest rates and abundant liquidity. The third is weak underlying growth in the real economy, especially when adjusted for inflation and productivity. These three conditions can coexist for a while, but they cannot all be resolved simultaneously. That is the trap. If policymakers tighten financial conditions to address debt and valuation excesses, they risk triggering sharp corrections in markets and employment. If they loosen conditions to protect growth and asset prices, they add more leverage and distort incentives even further. There is no clean exit. Every choice involves tradeoffs. This is why traditional policy playbooks are struggling. Central banks are supposed to manage inflation and stabilize cycles, but they are now also implicitly responsible for maintaining financial market confidence. Governments are supposed to manage budgets, but they increasingly rely on asset-driven tax revenues and cheap borrowing. When markets sense that authorities are constrained, they behave differently. Volatility no longer signals opportunity. It signals fragility. Another critical element of this mechanism is timing. Liquidity does not just support growth, it reshapes expectations. When investors believe that downturns will always be met with intervention, risk becomes underpriced. Capital flows towards speculative assets. Long-term investment takes a backseat to short-term gains. Over time, the economy becomes more sensitive to even small shocks. That is how stability paradoxically breeds instability. This is not theory. We have seen this pattern repeat across multiple cycles. What makes the current moment unique is the scale. The balance sheets involved are larger, the interconnectedness is deeper, and the margin for error is thinner. So when we talk about warnings from the United States and Japan, we are not talking about policy mistakes in isolation. We are talking about signals that the system is being asked to carry more weight with fewer supports. That is why the next steps matter so much. They will determine whether the system adjusts gradually or whether stress is simply deferred until it becomes unmanageable. With that framework in mind, let us start with the United States, because this is where the imbalance between markets and the real economy is most visible. Over the past decade, financial asset prices in the U.S. have grown far faster than wages, productivity, or output. Equity markets in particular have become the primary engine of perceived economic strength. This creates a feedback loop. Rising asset prices boost confidence in spending among those who own them. That spending supports growth in tax revenues. In turn, policymakers become increasingly sensitive to market declines because the downside effects are immediate and politically costly. This is how financial markets move from reflecting the economy to effectively steering it. The problem is that this system leaves very little room for error. Valuations today assume that earnings growth will remain resilient and that liquidity will stay abundant. Any disruption to either assumption creates outsized reactions. A sharp market correction would not just affect investors, it would hit consumption, hiring, and government revenues almost simultaneously. That is why rate cuts and supportive policies are framed as necessary, not optional. But this approach has consequences. Lower rates support asset prices, but they also weaken the currency and push capital into riskier areas. They reward leverage over productivity. Over time, the economy becomes more dependent on financial conditions rather than fundamentals. This is the quiet shift that matters most. It does not show up in quarterly headlines, but it reshapes incentives across the entire system. As we move into 2026, the U.S. finds itself in a position where allowing markets to correct naturally carries significant short-term pain, while intervening to prevent that correction increases long-term vulnerability. That is the dilemma. There is no easy resolution. The choice is between absorbing stress now or compounding it later. And when the United States makes that choice, the effects do not stop at its borders. They flow through currencies, capital markets, and global confidence. This is why what looks like a domestic policy decision quickly becomes a global issue. The U.S. is not just managing its own cycle. It is shaping the environment that everyone else has to operate within. Now let us turn to Japan, because this is where the global picture becomes more complicated and more dangerous. Japan is not a growth story. It is a funding story. For decades, the Japanese yen has functioned as a cheap source of capital for the world. Low rates, stable institutions, and predictable policy made Japan a cornerstone of global liquidity. But that role comes with a hidden cost. Japan carries one of the highest debt burdens in the developed world, and it has managed that burden only because borrowing costs remained extremely low. As Japan moves into 2026, that balance is under strain. The government is increasing fiscal spending to stabilize its economy, while the central bank is caught between inflation pressure and financial stability. This creates a paradox. If rates rise too quickly, debt servicing costs explode. If rates remain too low, the currency weakens and confidence erodes. What makes this situation more concerning is that markets are already signaling discomfort. The yen has struggled to strengthen even when policy tightening was hinted. That tells us something important. Investors are not just watching interest rates, they are watching sustainability. A weak currency in this context is not a competitive tool. It is a warning. As the yen weakens, the cost of imports rises, inflation becomes harder to control, and households feel the squeeze. At the same time, Japan cannot rely on foreign buyers to absorb unlimited amounts of new government debt. That means the burden increasingly falls on domestic institutions and the central bank itself. When a central bank becomes the buyer of last resort on a persistent basis, the line between monetary policy and fiscal financing blurs. This is not a sudden collapse scenario. It is a slow erosion of confidence. Japan does not need to fail for its actions to matter globally. It only needs to amplify existing imbalances. And when a major funding currency starts to lose credibility, the effects ripple outward through global markets in subtle but powerful ways. When you connect the United States and Japan together, the real story emerges, because these are not isolated policy paths. They are interacting forces within the same system. The US dollar and the Japanese yen sit at the core of global finance. One anchors reserves and trade. The other underpins funding and leverage. When both currencies face downward pressure at the same time, the impact is not limited to exchange rates. It reshapes capital flows, risk appetite, and inflation dynamics worldwide. As liquidity expands and yields compress, investors search for returns elsewhere. Capital moves into equities, commodities, and emerging markets. On the surface, this looks supportive. Asset prices rise, financial conditions loosen, but beneath that surface, vulnerabilities grow. Weaker currencies increase import costs. Commodity prices respond quickly. Countries that depend on external financing become more exposed to shifts in sentiment. Inflation that originates from currency depreciation is particularly difficult to manage because it is not driven by domestic demand alone. This is where second-order effects appear. Central banks in other countries face a dilemma: tighten policy to defend their currencies and risk slowing growth, or tolerate inflation to avoid financial stress. Either choice carries costs. Meanwhile, corporations operating across borders face higher uncertainty in pricing, supply chains, and investment planning. This is how monetary decisions taken in Washington and Tokyo cascade into boardrooms and households far away. Another critical factor is expectations. Once markets internalize the idea that major economies are willing to accept higher inflation to protect financial stability, behavior changes. Contracts adjust, wage demands shift, long-term planning becomes more defensive. These adjustments do not happen overnight, but they are difficult to reverse once embedded. This is why coordination matters. Without it, each country acts rationally in its own interest while collectively pushing the system toward greater instability. The danger is not a single shock. It is the accumulation of small distortions that gradually reduce the system's ability to absorb stress. Now we need to widen the lens even further and look at how the rest of the world fits into this picture, because global dynamics do not stop with the United States and Japan. China plays a crucial role here, not as a mirror image, but as a parallel force. Over the past decade, China has been one of the largest contributors to global liquidity growth. The difference is how that liquidity is used. Increasingly, Chinese capital is directed toward securing supply chains, commodities, and strategic inputs rather than recycling into Western financial assets. This shift has important implications. When liquidity chases real assets instead of financial instruments, price pressures show up differently. Commodity markets tighten. Input costs rise. Countries that rely on imported energy or raw materials feel the impact first. At the same time, many emerging economies are already dealing with higher debt and limited policy space. They are far more sensitive to changes in global financial conditions. A weaker dollar or yen does not automatically help them. It can trigger capital volatility and inflation without delivering stable growth. Europe faces its own constraints, balancing higher defense spending, energy transition costs, and political fragmentation. In this environment, there is very little slack left in the global system. Each region is responding to its own pressures, but the combined effect is a world where money is abundant and certainty is scarce. That combination is inherently unstable. It encourages short-term behavior and discourages long-term investment. It also increases the risk that a localized problem turns systemic, because buffers have already been used up. This is why 2026 matters. Not because everything will break, but because the system is entering a phase where mistakes are harder to absorb. The global economy is being asked to run hotter with fewer safeguards. That is not a prediction of disaster. It is a warning about fragility, and understanding that fragility is essential before we consider what paths lie ahead. So let us talk about paths forward, because 2026 does not lock us into a single outcome. It opens a narrow corridor with 3 plausible trajectories, each shaped by how policymakers and markets respond to mounting constraints. The first path is the melt-up scenario. In this case, liquidity continues to dominate. Rates stay lower for longer, fiscal spending remains elevated, asset prices push higher despite weak fundamentals. This path feels calm on the surface. Markets rise, volatility stays contained. But the cost is rising inequality and deeper dependence on financial conditions. Wealth concentrates further. Productivity remains sluggish. The system survives, but it becomes more brittle. The second path is a sharp adjustment triggered not by policy intent, but by confidence, a credit event, a sudden repricing, a realization that assumptions no longer hold. In this scenario, liquidity proves insufficient to prevent a correction. Markets fall, spending slows. Governments respond with emergency measures. The danger here is not the correction itself, it is the speed. Fast moves leave little room for coordination, turning manageable stress into systemic shock. Then there is the third path, and this one is counterintuitive. It is stagnation with inflation. Growth does not collapse, but it never fully recovers. Prices remain elevated due to structural factors like energy, supply chains, and currency dynamics. Rates hover in an uncomfortable middle ground, not tight enough to cleanse excess, not loose enough to reignite momentum. In this world, the economy feels stuck. Living standards erode slowly. Confidence declines quietly. None of these paths require a dramatic catalyst. They are shaped by accumulation and delay. What matters most is that all three outcomes share a common feature. Optionality shrinks. Once the system commits to a direction, reversing course becomes harder. That is why 2026 is so sensitive. It is not the end of a cycle. It is a fork where decisions made under pressure define the range of future choices. Markets can tolerate uncertainty. They struggle with constrained options. And right now, the menu is getting smaller. So let us bring this together, because the real lesson of this moment is not about fear or inevitability. It is about structure. The global economy is not on the verge of collapse, but it is operating with reduced tolerance for mistakes. The signals from the United States and Japan are not declarations of crisis. They are acknowledgments of constraint. When systems rely heavily on liquidity to manage risk, stability becomes conditional. It depends on confidence continuing indefinitely. History tells us that confidence is durable until it is not. That is why this period demands clarity rather than complacency. The choices ahead are not between good and bad outcomes. They are between different trade-offs: short-term comfort versus long-term resilience, financial stability versus structural reform, national priorities versus global coordination. None of these tensions are new. What is new is how tightly they are compressed in time. In a world where capital moves instantly and narratives travel faster than data, reactions matter as much as fundamentals. This does not mean disaster is inevitable. Systems can adapt, policies can evolve, coordination can improve, but adaptation requires recognizing limits. It requires accepting that money alone cannot solve productivity problems, demographic shifts, or geopolitical fragmentation. The danger is not that authorities act. It is that they act in ways that postpone adjustment while increasing dependence on the same tools that created the imbalance. 2026 will test whether the global system can absorb stress without amplifying it, whether it can prioritize durability over optics, and whether decision makers can preserve options rather than exhaust them. That is the real warning embedded in the current moment. So here are the questions you should be asking yourself as we move forward. Are we heading into another cycle where asset prices outrun reality, or are we approaching a recalibration that finally forces hard choices? And if stability depends on ever-increasing intervention, what happens when intervention loses its power? Let me know what you think in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.